Hi, good afternoon, everyone. Am I audible to all? Uh, Quick messages on the chat box will help. Hello?
Pawan, they can hear you.
Okay, perfect. So let's get started. Okay, so good afternoon, everyone. Welcome to the webinar on mastering the term sheet. My name is Pawan Sharma, and I'm a partner at DCL India. Today's session is on the term sheet and all the legalities that are covered in the term sheet. Before we get into the legal terms, let's quickly understand what a term sheet is. A term sheet is a legal document. It is served by an investor to the company, and it describes the investor's intention to invest into the company. The term sheet is a summary of legal terminology of the rights that the investor requests the company to give, and it also becomes the basis for the shareholders agreement, which is a larger document that the company, its shareholders, the promoters, and the investor would sign up. So term sheet acts as the first document, the foundation to build the shareholders agreement. Now, what I've done in the presentation is I have taken real life examples. These are real term sheets. Of course, with all the names and terms, important terms grayed out. But this will give you an idea of what real life term sheets will look like. Most of you here would be either raising your first or the second round of funds. Some of you might have already raised funds. You might be familiar with the whole process. Yeah, some of you may have seen term sheets. Some of them would be seeing your first term sheet very soon. So these examples will be of help to you. So if you see a typical term sheet begins with this language, I would like you to look at the first point, which says summarize the principal terms of a potential equity financing transaction, which means that the term sheet is not a guarantee that you will get money. Term sheet is only a proposal. The term sheet is an indication that the investor is interested in your company and would invest money provided the terms of this document are taken care of. So that's what a term sheet is. What are we going to learn today? So I have broken the whole presentation into three parts. First, we get the corporate structure. We understand what the corporate structure is. We get our foundation, and here we will look at who are the owners, difference between the owners and managers. What is the significance of the articles of association? We shall then look at what are the different instruments that are available to a company to receive money. And once we understand these two, we get into the legal terminology. So here I have split the whole term sheet into four broad groups. Instrument specific rights. We look at simple conversion, anti-dilution, full, anti-dilution weighted average. Board rights, board seat and observer seat, reserve matters rights, quorum, and relationship with founders, lock-in, ROFO, ROFR, tag-along, reps, warranties, and of course exit rights, liquidation preference. If you have any questions, you may please type them on the question box. Maybe in every 15 minutes or so, I'll take a break and try and answer them. Right? We have about an hour's time, and I'll try to cover as much as I can. And if I'm not able to cover a particular topic in detail, I may move forward, but you can always reach out to me on email if you have any questions. So let's get started. The corporate structure and the instruments, right? Let's understand the corporate structure. Now, multi-person structures, what are the options you have today? You have the simple partnership entity, you have the limited liability partnership, and you have company. And under company, you have two broad heads, public company and private limited company. Partnership comes with unlimited liability, so the personal assets of the promoters are at stake, so nobody opts for a partnership firm. LLP has slowly started catching up as a good investment vehicle, but again, that's very closely held. As far as company is concerned, especially private limited companies, that's how most startups are structured. It is the go-to structure for every startup. What makes a private limited company so successful, right? It is an artificial person, so it gets rights under the law as you and I would get. So the company can sue a person, the company can get sued by somebody, it can enter into a contract. So if you look at the term sheet or the shareholders agreement, the one of the signatories to the document would be the company itself, because it is an artificial person. The limited liability feature of a private limited company, that's how it derives its name. Limited means that the liability of the promoters is restricted to the amount of money that you've promised to put in. So it never extends to your personal assets. There is clear segregation between ownership and management. We'll touch on that topic very soon. Ownership units are defined as shares. So every share that you own is a unit in the ownership pool of the company. And through these shares, you get right to vote. And of course, the higher the shareholding, the better chances of your voice being heard. There are restrictions in a private limited company. The restrictions are to invite public to invest. So you cannot go to the general public and raise money unless, of course, you become a public limited company. And the restriction is also on transfer of shares. So you cannot transfer your shares to third parties unless you get the approval of the board. The integral feature of a company, as we have mentioned, is the segregation of ownership and management. So shareholders are the owners of the company, and at the center of this company sit the board of directors. So board of directors are the ones who manage the company. Shareholders, they take all major decisions, and these decisions could be categorized into ordinary resolutions and special resolutions. Ordinary are those which need 50% plus voting share, and special need 75% plus. And you can have different types of rights for different types of shareholders, and you can have a maximum of 200 shareholders in a private limited company. Board of directors, on the other hand, are those who are appointed to manage the day-to-day operations of the company. And the shareholders are the ones who appoint the board of directors. And you can have a maximum of 15 directors on the board, and you need mandatorily one resident director on every company's board. So though you can have 100% foreign shareholding, you cannot have 100% foreign directorship. One of them has to be a resident of India. What are the different instruments that are available to an investor to put money into the company? There are three. You have equity, you have preference, and you have options. So let's look at equity first. Equity are known as ordinary shares. So these are the primary owners of the company. And all decisions in the company are taken by equity shareholders, except for a few of them which are driven basically by contract. Under law, equity shareholders are the ones who decide the direction in which the company has to move. And they are entitled to a share of profit, which is in the form of dividend. And they also get a share in the liquidation proceeds, but they are in the last in the hierarchy when they have to get money as liquidation proceeds. Preference shareholders, on the other hand, preference shares or preferred stock, so to say, as the name goes, they get a preference in the participation with respect to profits. So they get the first right into profits, and they also get preference in liquidation proceeds. And they get dividends in the form of coupon rates, which is a certain rate, a fixed rate of return on the capital. And they are also convertible variants of preference shares. So you have a compulsory convertible model, you have an optionally convertible model, and a redeemable model. So compulsory convertible is it converts to equity. So today the investor will put money into preference and then it converts to equity. So compulsory convertible or CCPS, compulsory convertible preference share, optionally convertible or OCPS, and redeemable RCPS or redeemable convertible preference share. We will refer to them in our discussion as CCPS, OCPS, and RCPS. And these are preferred methods of investments into startup companies. So you will see your investor proposing that they put money into CCPS, OCPS, or RCPS so that they can get equity sometime in the future. We'll also see why they use this instrument. Options are unlike equity and preference, which are direct rights into the company. Option is a right to buy these shares. So it's an option is a right to buy equity, right to buy preference sometime in the future. The most popular variant of option is the employee stock options. Most of you might be familiar with this in case you've had prior corporate stints and you had access to the ESOP pools of your company. The other is share warrant. Now under share warrant, you again get a right to invest, a right to buy the equity shares of the company in the future. Now it's your option. So by that, it means that you may or may not exercise the option. If you do not exercise the option, basically lapses, so you don't get any shares in return. And if you exercise it, you'll have to pay the price. You'll have to pay the value attached to those shares under a contract to acquire the rights. Now, option price and exercise price are two considerations that you'll pay. Option price is at the time of buying the option. Exercise price is the time of buying the share. So these are two price points that you look at. Now, let's get into the legal terms. Let's look at certain rights that are connected to the instruments that we've just discussed, but more specifically the preference share instrument, right? The Right of conversion, the full ratchet anti-dilution, and the weighted average anti-dilution. Conversion rights. So what is conversion, right? Conversion basically means that at the end of the whole process of conversion, you will own equity shares of the company. Today, you might own any instrument, but in the future, ultimately, you would want to own equity shares of the company. So your instrument today might be a CCPS or a CCD, which is compulsorily convertible preference share or compulsorily convertible debenture, or an OCPS, optionally convertible preference share or debenture, and you opt to convert to equity shares. Now the conversion can happen by way of a trigger. Now the trigger can be either time-based or event-based. Time-based could be say 3 years. After 3 years, the money that I invest in CCPS will get converted to equity. It could be event based, meaning the next round of funding. You will see investors say this a lot. Today, I'll invest money into CCPS, but when the next round of funding happens, I will convert the CCPS into equity shares. The obvious question is, why does anybody put money into CCPS today? And it is because the valuation of startups, early stage startups, is not very clear. So preference share, in addition to giving the flexibility of structuring it the way you want, gives the added advantage to the investor to put money into the company and leave the valuation to an event, which could be the next round where valuation becomes clearer. Now, how do you determine how many shares the CCPS converts to? It can be by way of a formula, a simple ratio. For example, 1 is to 1.2 means for every one CCPS, you'll get 1.2 equity shares. Or it could also be based on price. And what it means is that you look at what is the next round of funding and what is the price at which the funding has happened. And you use that price, either use it directly or manipulate it by reducing the value, giving a discount, and then dividing the investment by the discounted price to arrive at the number of shares. So the question again, which early stage startups ask, is what is acceptable discount, right? We have seen some crazy numbers which go up to 30% plus, right? But the thumb rule is anywhere between 15 to 20% would be market accepted. So 15-20% of discount is quite reasonable, which means that the investor is asking for a 15 to 20% discount on the next round of funding. I have an excerpt for you here from a real term sheet. It says that CCPS shall convert to at 1:1 to ordinary equity shares, meaning every one CCPS will convert to one equity share. Of course, subject to anti-dilution provisions. We shall look at it later. And this is another excerpt. This is again a real life term sheet. If you see the discount, it is crazy, right? 1 to 2 years is 40%, and post the second year it is 50% discount, which means if you don't raise money post the second up to the second year and even beyond, you get a 50% discount on the next round, right? Which are crazy numbers. So please be careful when you sign up on discounts. You need to go through the fine print to understand what is the percentage of discount that you will be getting. Let's quickly take an example. ABC Private Limited received 3 lakh rupees and issued 10,000 CCPS at 10 rupees. Now, what are the different scenarios that are possible, right? Now, number of shares issued today, 10,000. Price today is 30 rupees, which is basically 3 lakh divided by 10,000. And 30 rupees has two parts, face value of 10 rupees, premium of 20 rupees. Let us assume that the company also raised the subsequent round and the price in the subsequent round was 45 rupees. So we have 30 rupees as today's price, 45 rupees as tomorrow's price. Now, scenario number one, ratio on conversion is 1:1.5. That means 1.5 equity for every one CCPS. So for 10,000 equity shares, the person will get 15,000 equity shares. The conversion price with the discount built in, if you look at these two numbers, right? If the subsequent round price is considered, which is 45 rupees, so what we do is we take 3 lakh, which is the original investment, divide that by 45. So 10,000 shares will convert to 6,667 equity shares. But if a discount is built in, you basically again divide that by 80%, and what you get is an additional shareholding of 8,333 shares. So discount is in the benefit of the investor. It is for trusting the company in the initial stage. And like I said, please be careful when you agree on a certain discount percentage. Let's look at anti-dilution. First, let us understand what is anti-dilution, right? To understand anti-dilution, we need to understand what is dilution. Dilution is a reduction of your stake. Your stake, as in the first people whose stake is reduced, is the promoters, right? You're the first people who give away your stake so that you get an investor on board. Now, investors will also dilute whenever there are subsequent investment rounds. Anti-dilution is the opposite of dilution, meaning the investor would want to protect the degree to which his or her stake reduces. Now, is there a possibility that there is no reduction in stake? Practically no, because whenever there's a round of investment, it is quite logical that there will be a reduction in the stake that the investor owns, right? But you can protect that under a contract, and which is what the anti-dilution clause is all about. So the investor will have the right to maintain his stake in the company. It's a protection against down round. Basically means if the price goes down in the next round, the investor is protected. And this is possible by adjusting the conversion ratio in case the investment is in the form of a convertible instrument. And if the investment is directly into equity shares, then by transfer of additional shares from the promoters to the investors, right? Now, this is again a real life excerpt, and so if you see here, it says that it refers to the broad based weighted average formula, right, for anti-dilution. Now we will look at what broad based weighted average is, but this clause basically says if you have issued shares at a price lower than the price at which the investor put money, then the investor is entitled to additional shares. That's what anti-dilution is all about. So we have two different types of anti-dilution rights, right? Basically a protection against anti-dilution. So we have full ratchet and we have broad-based weighted average. Now full ratchet means that the conversion price will be equal to the lowest down round. What it basically means, so Vikash asked the question, if I can explain anti-dilution once again, right? So let's take full ratchet because it's easy to understand. So if I invest money today into the company and the price per share that I pay is 100 rupees, I expect that the startup is going to improve and this price is going to increase from 100 rupees to something higher. But if the price goes down from 100 rupees to say 80 rupees, then I am at a losing end because the next investor who may put the same amount of money that I put will end up getting more shares than me, which is not fair because I trusted the company first. So the investor builds in this anti-dilution clause, which says that I want my right to be protected. And full ratchet means that the conversion price for me at 100 will be equal to the lowest round price. So please value my shares also at 80 rupees, which means I will end up getting more shares, right? So that is full ratchet. And at the end of full ratchet, the stake will remain the same. That's the idea of a full ratchet. And in today's world, it is considered to be extremely aggressive and it is not favorable to the company. So nobody opts for full ratchet conversion. If you see a full ratchet conversion, please run away from the deal because it is not in the favor of the company. You will end up diluting more stake, right? Broad-based weighted average is again the preferred method of anti-dilution drafting. What it means is that we arrive at an average price and it is fair to both parties. And the way we arrive at the average price is by using this formula. What it basically means is that we use the price of the previous round, PRP, and multiply that with this A plus B and divided by A plus C. I'm going to share this presentation with you so that it's easier for you to refer to this whenever you'd want. But the idea of the broad-based weighted average is to identify an average price point at which the conversion can happen. Let's look at an example very quickly. XY Private Limited has been established by X and Y, who own 100% of the company's stake, 10,000 shares. And in Jan, the company raises its first round, 1 lakh rupees, and dilutes 20% stake. In July, the company raises the second round of 75,000 and dilutes 15%. So today, the capital table looks like this. After the first round, X, Y, 5,000, 5,000, round 1, 2,500. 12,500, which means at the end of round 1, the investor has got 20% stake in the company, right? Round 2, that is 75,000 rupee of investment without an anti-dilution clause will mean that the investor stake will reduce from 20% to 17%. You see this movement, 20 to 17. That is what dilution is. So the stake reduces. Now, can this investor, round 1 investor, protect his or her rights? They can through the anti-dilution clause. So this is how full ratchet works. What full ratchet says is that my stake should remain the same even after the second round. So round one, 16% plus additional shares that I have to issue under a full ratchet anti-dilution clause of 4%. 20% is the same as what was on the first capital table that you see. The obvious question is who dilutes? It is X and Y who will end up diluting. So the founders are the ones who will end up diluting if the full ratchet clause is activated. And the way we calculate this is that we look at the round one price, which is 1 lakh divided by 2,500, which is 40 rupees per share. Round two price is 75,000 rupees divided by 2308, which is this number, which means that there is a dilution, there is a reduction in the price of shares. And so additional shares will have to be issued to maintain 20% stake. So these numbers, if you see, are very aggressive. The promoters end up diluting, and again, not in favor of the company. In the case of a broad-based weighted average method, we use the same numbers, but what we do is we arrive at a weighted average price. If you see the previous round, we had 33 rupees as the price, but if you apply weighted average, broad-based weighted average, the same price is 39.07, which means that the round one investor will not get 20%. The round one investor will get 16.9 plus 0.4, so around 17.3% of the company's stake, which is fair, to both the company as well as the investor. So that's the method that investors adopt, and that's the formula that you're going to see on your term sheet. So if you see a very lengthy formula on your term sheet under the head anti-dilution, you know that is a broad-based weighted average formula that's mentioned. It's fairly simple to calculate. Now let's look at board voting and governance. Now we look at board seat, we look at what reserve matter rights are, and we'll also look at quorum. Let's look at board, right? Like I mentioned in the previous slides, the private limited company can have a maximum of 15 directors. Maximum number of companies that an individual can be part of is 20 as a director. Now, if you look at foreign companies mandatorily need to have one resident director. So if any of you set up a US company, Singapore company, and want to set up an India R&D center or the India startup, you would need to have one resident director on your board. Rights that an investor would typically seek are board seat, which means that the investor would want to be more involved in the day-to-day operations of the company. And given that the investor comes with a lot of experience, this will definitely help the startup. Now, the investor may also choose to have an observer seat, because board seat comes with certain liabilities. There are certain risks attached to a board seat. So investors say, okay, I'm happy taking an observer seat, so I'll be part of the meeting, I know what's happening, but I do not want a board seat. So observer's seat has also become quite popular. This is again an excerpt from a term sheet where the investor has an observer right. The interesting thing about observers is they have to be silent unless they are asked to speak. So the observer does not by default have a voting right in the board meeting. The observer will have to stay silent unless he is asked to speak. There are two excerpts here, and the excerpt number 5, if you see, interestingly, it asks for one board observer seat for each of the investors. You have multiple investors, and in each investor will have one board observer seat. So you could have that. Right? The next point that we go to is reserve matters. And to understand how reserve matters work is, let's understand how corporate governance works. Most of the day-to-day decisions are taken by the directors of the company. Major decisions in the company, any strategic or economic decision, is taken by the shareholders, where we have the ordinary resolution, which needs 50% majority, and special resolution, which needs 75% majority. Now, in a private limited company, the law allows this right only to the shareholders of the company. And generally, the right is not available to a single shareholder to override these decisions. But under contract, through the shareholders agreement, you're able to enforce this right and state that certain important matters will have to be routed through the investor if it has to pass through. So what the reserve matter or the affirmative voting right states is that there is a list of matters decisions that cannot be taken by the shareholders or the directors unless you get a specific approval from the investor. Now, this is irrespective of the investor's vote share. So the investor may actually end up owning maybe less than 10%, but will still have a reserve matter right. And there are two major groups: structural alterations in the company, change in the capital structure, bonus shares, any share split that you want, share consolidation that you want to do, or economic rights. For example, if you want to take a loan from a bank and the value is beyond 25 lakhs, you would need the approval of the investor. Now, documenting approval of the investor under the reserve matter right or the dissent is very important, because if you do not have this documentation, it's hard to prove tomorrow that you had the green signal of the investor to proceed, right? So it's important that you get this. Now, this is an excerpt from a term sheet, and this is how a typical affirmative right will look like. So if you see, you have amendments to the capital AOA, the company's AOA, the ESOP structure, sale of any assets, creating subsidiaries, or incurring indebtedness. Quick question on what's the difference between observer and director rights. The observer has no right, so to say, right? The observer can only attend the meeting, can listen to what is happening in the meeting, but cannot vote. Director, on the other hand, has a lot of rights. The director can decide, can vote, can put matters to vote, and directors are in a far more powerful position than observers. But of course, with the directors, they also have added liability, because they are responsible to the company, to the government, to the other shareholders, and the liabilities are higher, and the investors would rather stay away from director rights. Let's understand quorum. Quorum is very closely connected to affirmative voting rights. So there are two ways of approaching the right that the investor gets into decision making. Right? Quorum basically means what is the minimum number of shareholders you should have for a meeting, and the quorum is 1/3 for board meetings and 2 members present in person for shareholder meeting. If the quorum is not present, then the meeting is adjourned to the next week, and if it is not available, then again it's adjourned, and then there is a law which says that if any decision is taken in a meeting which has no quorum, then that decision is void ab initio. Basically means that there is no decision taken, right? So the company will have to go back on any decision that's taken in a meeting which is not having a quorum. The right available to an investor is that the investor can state in the agreement that there cannot be a quorum in a meeting unless the investor or the investor's representative is present. It is very similar to reserve matter, which basically means if the investor is not physically present in the meeting, either himself or through a representative, then the quorum doesn't exist. So which means any decision taken in such a meeting is void ab initio. This is an excerpt which says that the quorum would require presence of a representative unless adjourned due to absence of such a representative. A quick question again: are directors salaried? Directors may or may not be salaried. For private limited companies, there is no rule which mandatorily provides for salary to directors. Again, there is no cap on salaries under the company law, so they may or may not be salaried employees of the company. Now this is a key section, right? Relationship with founders. So let's look at lock-in, reverse vesting. Very important to the promoters here. ROFO and ROFR, tag along right, and representations and warranties, right? This will take some time. Now, founder share. Now, founders are the ones who set up the company, right? They are part of the first share pool. And if there are no founders, then there is no startup, right? Because there's nobody else to run that company. So exit of a founder is going to affect the startup tremendously, which is why investors would force the promoters to stay in the company. And if they have to leave, then they have to give up a lot of the benefits that they were entitled to. So investors are very keen, peculiar. They are particular about the fact that the promoter will have to stay back in the company. So the first one is lock-in and reverse vesting. Lock-in basically means that the minimum number of years that a promoter will have to spend in the company so that the shares can be released. Now, lock-in and reverse vesting are connected. It means that during the lock-in period, the shareholder promoter cannot get any access to the benefits that can be derived from those shares. And if the promoter exits the company before this lock-in period, then the promoter will lose access to the benefits, will lose access to the shares. Reverse vesting connected to lock-in basically means that the shares will be released as and when the promoter completes the term. Right? So let's understand this with an example. Right? If The founder shall, let's look at this excerpt 9. The founder shall not transfer any equity shares in the company without obtaining prior consent of the investor before 3 years, which is the founder lock-in. Should the investor provide its consent to such transfer, the founder shall comply with other provisions of this clause, which means that the founder cannot transfer the shares, cannot exit from the company before 3 years. Also means in some cases, which we'll see, there's another excerpt here which says that these shares will get released 1/3 at the end of each year, which is what reverse vesting is. Forward vesting is something that you would see in ESOPs. Reverse vesting is something that you will see with the lock-in clause. If the founder exits, the question is, how did the founder exit? If the exit is peaceful, the exit is harmonious, then vested shares, the company can buy them back at the fair value, and the unvested shares can be bought back at the face value, the nominal value. But if the exit is acrimonious, if there is some issue, then the company might either buy back vested shares at face value, unvested shares will lapse. So we have seen agreements structured both ways, and you will have to go through your term sheet to see how it's structured in your particular case. Except number 10, the promoters or the shareholders shall not transfer. This is lock-in again, their respective shareholding, except with prior consent of the investor. All the shares individually held by the promoters shall be deemed to be reserved or unvested shares, reserved shares for the purpose of this agreement until the expiry of 3 years from the closing date. So extremely important clause. ROFO and ROFR. Now these are clauses that are linked to transfer, right? First we've looked at lock-in, we've looked at reverse vesting. Say the reverse vesting period is complete, lock-in is complete. Now you go and you want to sell the shares. Now this is not just applicable to promoters of the company, but also to any shareholder who want to sell the shares, including the investor, right? Now ROFO and ROFR clauses are price discovery models, and ROFO stands for right of first offer. ROFR stands for right of first refusal, and they can exist with or without a reverse vesting or lock-in clause. And it gives the investor to basically the right to buy more shares. So the investor is able to increase his shareholding. Right of first offer basically means if the founder wants to exit, the founder will have to first make an offer to the investor. The investor will make an offer, counter offer of the price of the terms, and if it is acceptable to the founder will sell the shares to the investor. If it is not acceptable to the founder can go to the outside market and check for better options. If the options in the market are better, then he can come back to the investor and state that I do not want to sell my shares to you because I have a better deal on hand. So unless the investor is able to match that deal, the promoter can sell the shares to the outside world. Right of first refusal, on the other hand, is a case where the promoter goes to the market, finds the price, and the investor then has the right of first refusal, meaning the investor refuses to buy those shares, and only then can the investor go to the outside world and sell. So like I said, the difference is in the price discovery. Under row 4, it is it's the investor's duty to give you a price. Under row 4, it is your duty to go and find out what the price is and come back to the investor. So there is an excerpt here. Again, I'll be sharing the presentation, so it's easy for you. Well, this excerpt speaks about ROFR, right of first refusal. Investors usually ask for ROFR because it is less of a headache for them to propose a price. It's easier for the promoter to go to the outside market and find out what the price is. It also helps the investor because the investor will understand what is the true value of the shares. Two quick questions. Related to presence, is physical presence mandatory or online presence is considered? The physical presence is mandatory for certain types of meetings. For example, the AGM cannot be an online meeting, but board meetings can be held online, but you'll have to record those board meetings. It is mandatory. How is the share value evaluated objectively? Now this is done through independent bodies like merchant bankers, chartered accountants, and now registered valuers. So they are the persons who value these shares, and it's accepted industry wide that an independent valuation would be the right value of the company, but there's no value better than what the market would be able to tell you if you go and sell these shares. Relationship with founders, again continuing tag along right. Now tag along right basically means that the investor has the right to tag along with the promoter to sell his shares. Now again, this is linked to transfer of shares. If the investor wants to exit to the company and the investor the investor's need to exit is far greater than that of the promoter, right? Because the investor would want to make his returns and get out. But the promoter, being closely linked to the company, is expected to continue and run the company for the future, right? Because the investor is there to make his returns. Promoters, when they exit, they go and sell the shares to the outside world. Now, the investor would want the right to be able to co-sell the shares with the promoter. So the investor would say that if you're going and selling your shares to the outside world, I would want to tag along with you and also sell some part of my shares so that I can get some cash. Now, this tagging along can be either a priority driven, so meaning the investor can get priority number one, and the promoter can get priority number two if the buyer has a constraint, right? For example, if the promoter has 100 shares, investor has say 70 shares, but the buyer says that I cannot buy 170 shares, I can buy only 130 shares. The investor will say, first you buy my 70, and then balance 60 you can buy from the promoters, right? The second option is that it is mixed, it is proportionate. So in my own example, the buyer, when he says that I can buy only 130 shares, we basically split that in the ratio of 100 shares and 70 shares, so that both the investor and the promoter are able to proportionately offload their shares. Again, real life except from a term sheet, it says that the tag along right shall be pro rata right so long as the total number of shares transferred by the founders is less than 50%. Very interesting. And if any shares in addition to the above are proposed to be transferred, investor shall have the first option to sell the shares. Meaning, if the promoter sells less than 50%, then it is proportionate tag along. If the promoter sells more than 50%, then the promoter will get priority number two. Investor would have the right to offload his or her shares first. Representations and warranties. Now, I have seen that this particular clause is not given a lot of attention to, and so it has a lot of repercussions in the future. What representations and warranties state is, it is an oath. It is a documented clause where the founders of the company state what all has happened in the company till the date of investment, right? So it is a statement of fact that the promoters are bound by, and the promoters state that all of these, the capital table or the organization structure or the directorship or the investments, the directors are basically, the promoters are basically taking an oath that all of these events are true. If the events are subsequently found to be false, or if the statements are found to be false, the promoters can be taken to task, as it is treated as breach. It is treated as an event of default, and a trigger of such nature would mean that the investor could even sell the entire company. So please be very careful with the representations and warranties clause. I've given some examples here in the organization capital financial statements head, and you are going to see these clauses in every shareholders agreement, but a foundation of sort will be established on the term sheet. Again, except number 3. So if you see this, it says that the promoter and the company shall jointly and severally defend, protect, and indemnify and hold harmless the investor if there is any claim arising by way of breach of any warranty. So very, very important clause. Please make sure you go through this in detail. It's a lengthy clause on the term sheet SHA, but please go through it. The final part of our presentation, exit rights, liquidation preference and IRR, and we will also look at drag along right. The exit rights, so of course, every investor is in the business of investing to make money, right? The investor puts money into the company, and the only way they make money is by exiting. So what happens to the investor if the company is wound up, if the company is sold? The liquidation preference is what is the clause that handles this. Now, the trigger here is the liquidation event, and the liquidation event could be a merger, sale of major assets, sale of subsidiaries, key management persons exiting the company. So you have these triggers. And when a trigger of this nature happens, the investor would want to exit the company, and exit in the way that the investor can at least get back his or her capital, or get back the capital plus certain returns. And those returns are called IRR, the internal rate of return, which is defined as a percentage. Basically means that the investor is looking to get back money that is invested plus additional returns. And if you look at this excerpt, it basically says that on the occurrence of a liquidation event, the holders of OCPS shall be entitled to receive in preference to the holders of the equity share. That means in preference to the promoters, an amount equal to 100% of the subscription money. So, which basically means that the investor will have the right to take money out of the system before anybody else is able to take money out, right? So that's what liquidation preference is. Now, drag is a clause where the investor is able to force the company to sell itself or sell its assets. Now, drag is a last resort available to the investor, because if you look at the sequence, the investor to get an exit will ask the company to first go for IPO, meaning the company is extremely successful. IPO is not possible, get into strategic sale. Strategic sale is not possible, then there's a put option in the company, basically means that the promoters will have to buy out the investor. And if all these options fail, then the only option left is drag. And what drag means is that the investor now says, okay, none of you are able to give me an exit, so I will now sell the company, and you cannot stop me from doing so. And drag is an exit right that the investor seeks in a window of 5 years plus. 5 to 7 years is what we have seen, which means that an investor should get an exit between 5 to 7 years. If they do not get an exit between 5 to 7 years, then the drag right is activated. And this number could be lower. If it is lower than 5 years, I've seen 3 years as well, but you need to negotiate very hard to make sure it's not very low, because it's practically not possible to give an exit unless you have reached a certain stage or maturity in your business life cycle, right? Now, if the investor uh, forces the company to sell all its assets, forces the promoters to sell the company itself, please note that the investor can sell the company to a competitor, and he can sell complete shares, and the founders will not be able to stop the investor from doing so, right? Now, this is an excerpt again, and the investor will be entitled to exercise drag as defined, and so on and so forth. But the company and the founder have not provided the investor with an exit or the next round qualified round even after 5 years. So, which is when the drag clause gets activated, and the promoters are bound by the terms that the investor will agree with the third party. All right, so that brings me to the end of my discussion. Now let's have a Q&A session. I'll be happy to take any questions that you may have. I think we'll have 10 minutes for Q&A. Okay, first question. In a service-based firm, does only physical asset hold value, or even the team has a value? The team definitely has a value. What we call the intellectual property, right? Be it what you create. It could be either a patent, it could be a copyright, it could be a code. In addition to all of this, also the team, if you have an experienced team, even that has value. So you might have heard of the term of acqui-hire, which basically means a larger company who might not be interested to create a team from day one, might simply acquire another startup, and that's a way by which they can hire this talent. And of course the startup can charge a premium for it, because the team definitely has a value. What are some extreme clauses in the term sheet which should raise red flags? So you would need to make sure that none of the promoters are personally liable, and that would basically mean you look at the term sheet under a microscope to make sure that, and also clarifying this with the investor as a question upfront, that the investors do not hold the promoter personally liable to repay money, because in the liquidation preference or in the drag clause or the put option clause, they would have included a term which puts the onus on you on a personal front to acquire that money, which means that the liability now becomes unlimited, and the investor then has the right to come to you and ask you to buy the entire capital. And if you do not have the wherewithal, then it gets into a court matter, right? So that's extremely important. Second is drag. Please, like I said, do not agree to a drag which is 2 or 3 years, because it is too short a period of time. That's another extreme clause. IRRs, again, I have seen 25% plus IRRs, which are very hard to achieve in today's world. So please make sure that you do not agree to something that is 25% plus. Next question, is it necessary to have a board of director while selling a small stake uh, in a private limited company? Uh, Board of director is mandatory. Even if he was going to sell a small stake in the company, say 5%, unless the articles of association or a contract exempts you from doing so, you would not be able to circumvent the board of directors. You would still have to go through the board of directors. So it is always mandatory to route a share transfer through the board of directors under law, unless your articles of association exempts you from. But I have not seen a single article of association which exempts you from going to a third party without going through the board. So it becomes mandatory. Can a shareholder, by buying equity shares, gain the status of a promoter? Is there any benefit to it? Yes, you can as a shareholder. See, promoter is a term under law. Basically means the person who first start the business, right? So by just acquiring 100% of the capital of the company, you do not by default become a promoter of the company. So promoter might not be the right term here. Maybe you become the majority shareholder of the company. And as far as benefits are concerned, it's basically the optics, right? How do you appear to the outside world? Now, you may call yourself a promoter as a signatory to the MOA, or you may become the 100% owner of a company as a major shareholder and say that you are still the person who drives the decisions in the board. Minimum size of board of directors, 2. So you need a minimum of 2 directors. Oh yes, I've heard some investors use safe agreements. How is it accommodated in the term sheet? So there was news about safe agreements recently, but there's no safe agreement concept in India. You have safe agreements outside India, in the US and Singapore, but not in India. Safe agreement stands for I think it is a standard agreement for equity, I guess so. But what it means is that you get money today, but you issue shares in the future. The company law, unfortunately, in India does not permit you to get money today, but issue shares on a later date. So safe is not possible in India. The only option, the only alternative to a safe agreement is a CCPS agreement. So the CCPS instrument is you take money today, give CCPS, and they convert into equity in the future. Where does OPC firm stand in terms of investment? Now, OPC stands for one person company. One person company means that there's only one person driving business. So it's a company into which nobody can invest. So OPCs are not the instrument, not the structure in case you want to raise money. So if you have an OPC, if you're running your business in the form of an OPC, because we recently dealt with a case where we had to convert the OPC, and not convert, actually go through a complete process to make sure that we have a new private limited company acquiring the assets of this OPC, because OPCs are not the structure that will attract any investment. You cannot have more than 1% there. So if any of you have OPCs, please move to private limited companies and not OPCs. All right, so I hope I've answered all your questions. Now, quickly about us, BCL India, it's a multidisciplinary consulting firm. We are based out of Bangalore, and that's about me. So I'm a CA by profession. I handle the startup advisory and the business structuring division of our business. So which means we help startups structure transactions well, valuations, term sheets, the legal terminology, ROC paperwork, and all of that is handled by us. I'm also on Twitter, and you can also go to our website bclindia.in/news to read some of the latest articles that we write on startups and taxation or corporate law matters. So thank you so much for your patient hearing. If you have any questions, feel free to write to me. My email ID is pawan@bclindia.in. It's on the screen now. I will definitely share the presentation with you through the Intuit Circles group. Thank you so much for your patient hearing, and have a lovely day ahead.